10 years ago, two people I know made completely different bets with their money. One of them fell in love with dividend stocks and the passive income pitch. Get paid just for owning the stock, checks landing every quarter, forever. It sounds like the dream, right? Money for doing basically nothing at all. The other one did something incredibly boring, bought a total market index fund. And simply didn't touch it for 10 full years, no adjustments at all. Today I'll show you exactly what happened to both of them, real numbers. No cherry picking, no hype, and honestly, the results surprised even me. Let's start with why dividend investing is so seductive in the first place. The pitch: instead of hoping a stock rises, you get paid directly. Every quarter, like clockwork, from companies sharing their profits with you. Companies like Coca-Cola, Johnson & Johnson, the boring but reliable giants that have paid, and often increased, dividends for decades in a row. The dream: build a big enough portfolio, and dividends cover your expenses. You never sell a single share, just collect income forever, essentially. It's a beautiful story, and for some people it genuinely works out. But here's what that pitch usually leaves out of the conversation entirely. Let's go back to my friend who chose dividend stocks a decade ago. Let's call him Imran. He built a portfolio of 20 companies. Real household names, genuinely good businesses, reliable dividend-paying reputations across the board. Most kept paying, and many even raised dividends most years, as promised. But here's the part nobody talks about at dinner parties, honestly speaking. Dividend stocks dramatically underperformed the broader market this specific decade overall. Why? Because the biggest winners, massive tech companies, pay almost nothing. They reinvest profits into growth instead of cutting checks to shareholders. So while Imran collected quarterly payments and felt good about passive income, his total portfolio value grew noticeably slower than the broader market overall. This is sometimes called dividend trap thinking in investing circles today. Chasing current yield while missing out on aggressive growth reinvestment elsewhere. Now let's look at my other friend, Sana, who bought an index fund. Her fund automatically owned a little piece of literally everything available. The dividend payers Imran owned, plus the growth companies he didn't. She didn't pick winners, didn't research which dividend was safe enough. She didn't rebalance anything or make a single active decision, really. Over the decade, her total return ended up meaningfully ahead of Imran's. Not by a tiny margin either, a genuinely noticeable gap developed. Sometimes measured in tens of thousands of extra dollars, comparably invested. Let's put actual figures to this, using simplified but realistic numbers here. Both Imran and Sana started with $50,000 10 years ago. Neither added another dollar afterward, to isolate the actual decision itself. Imran's dividend portfolio, price plus reinvested dividends, grew to about $85,000. Sometimes reaching $95,000, solid growth, nothing to be ashamed of. Sana's index fund, over the same decade, grew to around $115,000. Sometimes reaching $130,000 over that same period. A gap of roughly $30,000 to $40,000, same starting investment. Same 10 years, dramatically less effort and research required from Sana. These numbers shift depending on the specific decade and stocks chosen. Different windows in history have shown genuinely different results sometimes though. There have been periods where dividend strategies held up better relatively. Particularly during downturns, or when growth stocks specifically underperformed instead. This decade simply favored the total market approach strongly, for specific reasons. This brings us to the actual myth: dividends are extra free money. They aren't, not exactly. When paid, the stock price typically drops equally. You're not getting free money, you're getting your own investment back. The company is worth slightly less because that cash left the business. This doesn't mean dividends are worthless, they can be genuinely useful. Especially for people needing actual income during retirement years specifically. But dividends aren't a magical bonus layered on top of normal returns. They're one part of your total return, not an addition to it. The myth that dividend investing is safer deserves a closer look too. Dividend companies can and do cut dividends during hard times sometimes. More often than people assume, especially during recessions or industry downturns. A dividend isn't a guarantee, it's a decision made every quarter. Now, I don't want this to sound like dividend investing is pointless. For retirees specifically, dividend income provides useful, predictable cash flow reliably. Without needing to sell shares during a market downturn, which matters practically. There's real value in not selling stocks at a bad price for income. Dividend stocks also suit investors wanting lower volatility over pure growth. Mature, established companies tend to swing less dramatically during downturns generally. For some investors, the behavioral benefit matters more than the raw math. If dividends keep you calm and invested instead of panic selling everything, that emotional stability might genuinely be worth some lower total return. A strategy you can actually stick with beats one you'll abandon. So here's a simple, honest framework for thinking about this whole decision. If you're young, still working, with decades ahead before needing income, a total market index fund is likely the more efficient long-term choice. Based on the data we just walked through, and broader historical evidence. If you're retired, or approaching it, needing predictable income without selling shares, a thoughtful allocation toward dividend-paying stocks can serve a real purpose. If you enjoy researching individual dividend companies, that engagement has value too. Just go in with clear eyes about the likely growth trade-off. The honest answer isn't dividend stocks are bad at all, honestly. It's that both strategies solve different problems for different life stages. Most people in the wealth-building phase are optimizing for the wrong one. Now, someone's going to say, but this was just one single decade. What if the next 10 years favor dividend stocks instead? Fair point. Markets move in cycles, and dividend-focused strategies have outperformed before, historically. Particularly following periods when growth stocks became historically overvalued somewhere. Nobody, including me, can predict with certainty which approach wins next. But history shows total market index funds reliably capture whatever growth happens, without requiring you to correctly predict which specific style wins in advance. So here's the honest conclusion after actually running the real 10-year numbers. For most people still building wealth, index funds delivered stronger overall growth. Not because dividend stocks are bad companies, genuinely good businesses actually, but because chasing dividend income quietly sacrifices exposure to fastest-growing markets. That doesn't mean dividends have no place in a smart portfolio though. It means understanding exactly what job you're hiring them to do. If you currently hold dividend stocks, I'm not saying sell everything tomorrow. That's a personal decision based on your goals, timeline, and full portfolio. But now you've seen the honest 10-year numbers behind this decision. Tell me in the comments, Team Dividend Income or Team Total Growth? I genuinely want to hear your reasoning either way, no judgment here. If this gave you a clearer way to think about your portfolio, hit subscribe, because next week we're comparing another popular strategy honestly. I'll see you in the next one. Thanks so much for watching.